and welcome. You're watching Your Trades. I'm Kavita Thapliyal and with me is my colleague Mansi Dave. And Mansi, what a week. The market tried holding itself steady. Thursday session ended above 24,600 and the broader indices also tried participating but then almost were flat with a lot of stock specific action, and obviously the earnings season got over and now we are waiting for the next week action.
Absolutely, Kavita. I see this as a very interesting week because
Apart
from the index-specific approach and the good sustaining levels, even when it was a truncated week, this week witnessed a lot many economic indicative actions, and all the actions were good enough. We had the AMFI data where we did see the SIP record inflows and the constant conviction from the market participants. At the same time, we also had the inflation print, WPI data points, and last but not the least, in the last trading session, we also had an upgrade coming from S&P where India did see an upgrade from negative BBB to positive BBB, and owing to all the positive parameters which were declared in those as the parameter for which it has got this positive upgrade, right from the growth scenarios to the capex front. And we also did see a lot of development, and in particular a statement that no matter how many uncertainties come from the tariff front, but Indian markets are strong enough to digest all of it and behave in the way which is quite mature and positive on that matter. For that matter, moving ahead, the week gone by, and how was the entire market during the session, during the week in particular? Is it being the weekly roundup? We need to understand how did it pan out throughout the week. Nifty did snap 6 weeks losing streak on a positive note, and it was led by many counters, right from the pharma space, the hospital, diagnostic, new age development, new age technology stocks, and at the same time the consumption also will start picking up from here on because festival demand will start adding up. Nifty mid cap and small cap did snap 3 sessions losing streak. We did see opportunities during the last trading session. Mid cap and small cap did show signs of negativity, but at the same time, if you see the weekly performance of mid cap and small cap, it was showing signs of positive gains and a lot of stock specific opportunities in the small and mid cap buckets. Nifty, FMCG, all major sectoral indices did close in green. We did see a good positive momentum in the metals where it was a shine. Real estate were trying to perform. FMCG, consumption, automobile, auto ancillary, all of which doing a positive rounds. So if I sum up the week, Kavita, I feel the indices were trading better on a positive note, the sectors were good, and stock specific approaches were many.
So now it's time to get your strategies marked out for the next week, and for that we are also joined by our experts. We have Nilesh Jain, Head Derivatives and Technical Research, Centrum Broking, and we also have Sunil Subramaniam, Market Expert. Good evening and welcome to the show. Nilesh, I'll come to you first because we really want to get a sense of the market on the technical charts. Now the resistance according to you, and the entire week has been somewhat good for the market. We can say it closed steady as well. A lot of stock specific action. What is the way ahead in terms of support and resistance level on Nifty and Bank Nifty?
Very good afternoon to you, Kavita and Mansi. So looking at the rebound that we have seen in the week, in this particular week after 6 weeks of consecutive declines, so clearly we are likely to witness a follow-up on the upside on the back of a retracement and also on the back of a short covering move that we are expecting from here. The FI long-short ratio has gone into extremely oversold territory. Even on technical front, the markets were trading in the oversold territory. So from here, we are expecting a strong pullback in the coming week towards the levels of 24,750, 24,800. On the lower side, the good part of the Nifty's move, today's move, is that it has managed to end above 24,600 and also above its 100-day moving average as well. So looking at the overall setup, looks like a gradual up move is something that we can expect Nifty in the Nifty index towards 24,700, 24,800 on the upside. Similarly, Bank Nifty, although it has been a laggard, but we have seen some positive momentum in the Bank Nifty as well. 55,000 is acting as a very strong support, and throughout this week we have seen Bank Nifty defended 55,000 levels. So that's the positive sign. We are expecting a move towards 55,600 and 56,000 on the upside. So the better approach should be to focus on sectors and stocks. On index front, yes, long position can be initiated, but buy and dip should be the strategy.
On dips is the strategy, conviction and undertone for the market remains positive. We also have Sunil Subramaniam, market expert, joining with us. Sunil, thank you for giving your time to ET Now. Mansi this side, it's a pleasure talking to you. Last session, when I was having a word with you on the same platform, I was happy to discuss the latest AMFI data, where SIP flows increased to all-time high of 28,464 crore. And this time, when I'm talking to you, I'm happy to discuss the S&P rating upgrade for India. S&P has upgraded India's rating to BBB. How do you see this as a significant parameter for the investor sentiments?
So I think first of all, you've got to look at the reasons for the upgrade.
Yeah.
I think more than just the statement of the upgrade. And if you see two things they've spoken. One is the government's move towards fiscal consolidation. The second is the RBI's supportive monetary policy. So I think if you look at it, that means they are looking at the fundamentals. They're looking at how is the country being run. What I'm saying is when we look at a stock, right, we look at the corporate governance of the stock before deciding, because markets will come up and go, business will go up and down. How is the owner of the business managing his business in the proper way? Has he proper planning? Similarly, for that, the equivalent of the owner of a business is the RBI plus the central government, the fiscal and the monetary policy. So I think it's a big thumbs up to the way the country is being run. So that's one thing. So once you look at it now from that perspective, you realize that this has come after the announcement of the tariffs, which means that the bad news of the tariffs on the economy and everything they've taken into account with the confidence that the fiscal plus the monetary policy will take adequate action to compensate for whatever loss due to tariff. So it's a very forward-looking rating to have come out at this point. If I come it last week, then just like RBI governor had stated that growth is fine, and then the tariffs came and hit, you would have worried about whether the rating is going to get impacted by the tariff. But this has come after the tariff announcement has come. So I would say that it's a big thumbs up to the way they see our country managing, that we can handle this tariff situation. So that's one thing. Second thing that this rating upgrade does is that from an investor sentiment for DIIs, I don't think it really mattered, because DIIs were flush with money. They were always confident about India's growth story, and they have been consistently buying, driven by, of course, the investors giving them money. But for FIIs, right, there are various types of FIIs there. And I'll point two types of FIIs here. So first is a long-term FII, the one who looks at 10, 15-year growth outlook. For him, the risk and reward play a part. In this country, how much risk I'm taking, because I know India's growth story is good. Now that the risk has come down a notch because of the rating, their confidence in allocating more to a growth country like India will go up. So I expect long-term FII flows to come in. The second is from a short-term FII, like a hedge fund. What they see in the short run is things like oil prices going up and down, things like currency going up and down. So one of the things that a rating upgrade does is that it makes the currency stronger, because the riskiness is a factor in the currency, right? So once you see that India then is not going to depreciate so much, then for an FII who's taking a punt on India or another emerging economy from a 3-6 month time frame, the loss from currency will be much less from a country that's just been upgraded. So their inclination to allocate more to India will go up. And one portion of hedge funds, in fact, don't even apply their brains to it. They do it what is called as algorithmic trading. That is, they feed data into a computer, which throws them up the number, and very often the computer executes those trades. So once this rating is fit into the system, India's eligibility to get more money automatically sits up, and I would expect some amount of buying to step forward. Okay. So I think that rating goes a very long way, especially in these uncertain times, to have had a US rating agency to give a positive thumb up.
Yeah, that's a reality check for the US as well. I really want to ask a question to Nilesh, but then Sunil, for you, I think we should make it mandatory to have a dialogue in every answer. I am giving you a chance to use one dialogue now. I want red flags. I want 3 red flags that you would want to count for us now going ahead.
So first red flag actually is a very contrarian one. Okay. It's that the inflation is going on coming down, which is good from a rate cut, good from RBI. But for the rural economy, if food prices come down, the money in their hands is going to be down. The second is that if this inflation stays low, India's nominal GDP will come down to around 9% from the 10 that we expect in the budget. So automatically the stock market, everything relates to nominal GDP. So I don't want this low inflation to persist. I think a decent 3 to 4% inflation is acceptable and should be there. So my biggest worry is this low inflation scenario continuing will hurt the mood. If you go back to the year 2018, it was a negative rural inflation which led to a slowdown in the Indian economy. So my biggest red flag is let not this inflation keep slipping into negative territory and very low. It should be decent. So first red flag is that. Second red flag is, well, people are taking the 1 lakh crore of giveaway and putting into savings. You're seeing that in the mutual fund flows in the SIP book. I want them to spend. They're still not showing the inclination to spend the money that the government is giving to them. Now, this festival season is a big, big examination for that. In this exam, if people don't switch into consumption, unless their mood changes to buying, it's not going to be good from a stock market earnings perspective, because just saving everything means that the mutual funds will go on buying and the valuations will remain high unless the growth comes and justifies it. So the second worry for me is the Indian consumer or the Indian citizen going to change his mind from savings into consumption? That's a red flag. If that doesn't happen, again, earnings are going to disappoint, right? And the third thing here is that, you see, if the Fed does a rate cut, as now 95% probability almost of a September rate cut, the pressure on RBI to do a rate cut is obviously there. But if RBI does a 25 basis points rate cut, is okay. But if they show a 50 basis points rate cut, it's a red flag for me. Why? That means RBI is worried about growth. So I don't want that to happen. That market prays for more and more rate cuts. Yes, it's a short-term bump up the market will get. But long-term, if the RBI is going to go to 50 basis points, it means there are some worrying signs on the growth aspect, which
Right, and that was like a quick know-how of what's happening and what should be considered as positives and negatives also, the impacts and the concerns also. Sunil, thanks for giving that view. But coming back to you, Nilesh, stock-specific approaches, if we see indices-wise, yes, markets did manage to sustain those 24,600 levels. But what are the trading ideas for the sessions next? Which sectors should one eye? And in particular, if you have any scripts in your mind, do let us know.
Right, Mansi. So we are watching out for OMC space and the crude-related stocks. We are expecting a positive move to continue since we have already seen a meaningful correction in the Brent crude. So that will be a supportive for the paint stock as well. So within paint space, Asian Paint, one of the beaten down stocks. Recently, we have seen a good momentum coming back in this particular counter. So structure-wise, a long consolidation breakout, I would say the stock has given a breakout from its past 10-11-month consolidation. Looks strong for a further momentum to continue on the upside. And we are expecting a move towards 2600 to 2620 on the upside. So 2480 will be the stop loss for this particular counter. Asian Paint is a buy from a short to medium term perspective. Apart from that, we have seen a strong move in Manappuram Finance and Muthoot Finance, specifically post numbers. So Muthoot Finance has given a big spurt, and similarly, setup for the Manappuram Finance is also looking strong. We are expecting a follow-up move to continue. Today, we have already seen a strong breakout with a good volume participation. So Manappuram Finance is a buy with a stop loss below 260 and target would be 274.
Muthoot Finance, Manappuram Finance, you picked it right there, Nilesh. That was on my radar as well. And of course, on the back of positive news flows and result-backed action, the stock was on focus radar. Muthoot, where it did see a 10% upsurge in the trading session. But then if we talk about the sector-specific approach, both pharma and automobile sector were doing good throughout the week. And in particular, if we talk about pharma, it did play a good role of defensives in the past few sessions, in the past month at least. But after the tariff implications and the news flows coming in for pharma sector as well, Sunil, I see pharma sector also seeing signs of volatility. Now, as I always say, that pharma is not just a sector, but it has subsectors in it as well, where we talk about healthcare, diagnostic, laboratory, CDMO, hospital, all of it. Is this dip an opportunity to enter, or is this volatility rather an opportunity to enter?
Yeah, actually, the big Damocles sword, if they call it, is Mr. Trump talking about ultimately going to 250% tariff, or alternatively putting pressure on the pharma companies to reduce prices, which means it's at the cost of margins. So I think that's the one big uncertainty around which is affecting the pharma, because actually the earnings season for pharma has been fairly decent, right? So to that extent, I would say that you take a balanced approach to pharma, which is that you balance your portfolio between external oriented generics and CDMO and domestic oriented hospitals, diagnostics, and the likes, right? Because the earnings season has been good. It is a defensive sector, and I think when FIS come back, they will definitely allocate to this sector. Except that Mr. Trump, what he does about pharma is a big question because there are two views about that. Though he talks about this, ultimately the US government foots the healthcare bill, and so any tariff can mean that the US's subsidy goes up. So the cost will have to be borne by the government and not by the consumers there. So to that extent, I would say it's better to hedge your bets there. Stick to that as a reasonable part of your allocation, but balance it between external oriented and domestic oriented so that you're protected in the event of some bad news. At least the domestics will come and support you.
Absolutely. So that's a take coming in for pharma. There can be some volatility, but then conviction for at least the domestic pharma stays. Nilesh, what is to be done with the mid-cap IT plays? There was a time when the IT sector was not performing when we started with the earnings season, of course, because major IT majors were not giving good set of results. But then in this entire week, if we see, it was the mid-cap IT plays which tried to see a comeback. Should we consider this comeback promising, or we need to wait and watch?
See, Mansi, Nifty IT index has been a beaten down sector. We have seen a decline all the way from the levels of 39,200 to 34,500, 34,400. So that was the recent low that we have seen in this particular index. Now, looks like it has gone into extremely oversold territory. The major results have already been spun out within the IT pack. And it seems like the worst is behind for the IT space, at least from a short to medium term perspective. The risk and reward is looking attractive at present level. So I would like to bet on the large cap IT names like Infosys, HCL Tech, TCS, or maybe Wipro as well. So these are the stocks that are showing signs of rebound from the lower level. So we can expect a momentum to continue from at least from August series expiry point of view. As far as index is concerned, 36,000 level is something that we are expecting, and 34,200 is acting as a very strong support. So till then it doesn't break below the same, we can expect a gradual upmove to continue. Within mid-cap IT pack, Persistent, LTIM, Coforge are the couple of stocks. We have seen a strong momentum today, but towards the closing up, we have seen some bit of profit taking. But the overall setup looks positive from a short-term perspective. We are expecting this pullback to continue.
All right, so we expect the pullback to continue. Sunil, this question I think is always in the minds of all the investors, be it a bigger investor or a smaller investor for that matter. What is to be done from the large cap as well as the broader market perspective? When we compare it all, large caps seem to be expensive, and the broader market, mid cap and small cap, they seem to be a bit risky. How shall we strategize the portfolio, and should we also consider mid cap and small cap as a part of our portfolio while we are drawing the portfolios?
Yes. So I would say that I have a word for this, that you should smell the money. What do I mean by that? So I say that where is the money going to come and buy? That's where you should allocate in this period. So now if you look at two things, right? One is that this S&P rating upgrade, I expect it to tilt to a positive FII tilt in the coming weeks, right? So that means if FIIs are coming back, naturally their preference will be for larger cap stocks in that. So there's likely to be, despite the valuations being expensive, I think that the momentum of a positive currency outlook, a positive rating, and all of that will drive the FII flows back into the country. So a large cap should definitely be part of your portfolio. At the same time, as we discussed in our earlier show, 40% of the flows to the mutual fund are in the mid and small caps. So domestic fund managers have no choice but to buy mid and small cap. Now, since there the valuations are quite high, and you mentioned risky because of the volatility, the fund managers will be looking for growth stocks there. So there, it's not the valuation is concerned, it is the growth stock which justifies the high valuation that the fund manager will be searching for. So it's hazardous for a retail investor to try and buy mid and small caps on his own and rather allocate it to a mid cap, small cap fund, because the fund managers will then choose the right stocks with a good growth outlook. So I would say then end of the day, if you want to do, it's 50% in large cap, 50% mid and small. It's a good way to hedge your bets in this scenario. But the mid and small, I would suggest that you give it to a mutual fund manager so that he can allocate it to the right sectors and stocks.
Yeah, that's quite an answer, and thanks for that, because it's always been in the minds of investors, and we also keep trying to figure out whether what to do, because at times like the session, last trading session, where we did see the mid cap and small cap seeing absolute volatility while the markets were trying to perform. A quick view, Nilesh, on ICICI Bank. After receiving backlash, widespread backlash on Wednesday, it did roll back its recently announced requirement for new account holders to maintain the minimum average balance which it decided of 50,000. Do you see the stock performing in the week next?
So Mansi, we need to see the broader structure for this particular stock. If you see on the weekly time frame chart, all the way in last 5 years after testing the lows about 300, the stock is constantly trading in the upward trajectory, and it has a very strong undertone. Whatever decline we are witnessing is getting bought into. It has a very strong support somewhere around 1380 to 1400 zone. So overall, structure-wise, looks strong. If at all you see any meaningful correction going forward, use that dip to buy. It's a portfolio stock. We are expecting a gradual upward towards 1500 plus. So it's a buy and decline kind of structure. If you get any dip towards 1400, that will be a good entry point from a risk and reward perspective. 1380 will be the stop loss.
Sure. Sunil and Nilesh, gentlemen, thank you so much for giving your time and joining with us, helping with us for the fundamental as well as technical approach on the market. Have a nice day and a great long weekend to both of you. On that note, it's a wrap on this edition of Your Trades, but there's a lot lined up on the other side. You stay tuned with ET Now. Thank you.